welcome to the webinar for the best business benefits of the one big beautiful bill. It is now law, signed into law last Friday, and we want to go over some of the primary benefits that's really happening for business owners, and that's key to what we do. Peter Holtz CPA, we're a firm of about 85 people. We're one of the 400 largest firms in the United States. We work helping business owners save money on taxes. We also provide all other services that are completely integrated into our tax planning services. Obviously, the accounting bookkeeping side, we do audits, reviews, we do tax preparation as well. And business advice and consultation is also something that we work on very heavily. So I'm going to get into it. We only got about an hour. There is a lot. I believe the final bill was around 950 pages or so. There's a lot to do, but I want to focus on the primary issues, right? Tax credits and deductions, health and medical related provisions, business tax incentives, energy and environmental provisions, and also certain tax reforms that they implemented. So some very interesting stuff that has happened in this bill. Tax credits and deductions, business deductions and credits we're going to talk about. So the first thing is the QBI deduction, the Qualified Business Income Permanent Enhancement, right? The QBI deduction originally came out in the TGCIA, the Targeted Jobs and Tax Credit Act of 2017. And it was meant to be temporary. Now they've made it permanent so that any pass-through income has a QBI deduction of 20%. Now, if you're what's called a specialty service trade or business, an SSTB, you don't always get to take that QBI, okay? So there's several important elements of that in that, if you're below the threshold for taxpayers, under income limits, 191,000 single, 383,000 married. Above that threshold, you get 75% of the excess income over the threshold, reduces the limitations and so forth. So it's now going to be adjusted by inflation. And the important thing is they also increase this to a 23% deduction. As you can see in each one of these things, and we're going to send out these slides, okay, to the people that are participating in the webinar. But in each one of these, we have, the relative paragraph, we have the House version, the Senate version, and with the changes and the impact and the overall impact on business, right? So 23%, you as an S corp or an LLC or even as sole proprietor should be able to take 23% of your income as a deduction to limit your income tax exposure. Okay, so the second thing that they did that's really significant is estate tax. Okay, estate and gift tax. If you remember, it was raised to a limit of like 12.9 million, or actually it was like in the 11 or 12 million range, and it adjusted up for inflation. So it was currently 12.9, which is the estate tax limitation. Okay. Now the way and what this bill does is it makes that limitation permanently 15 million. Okay. It was going to revert down to 6 million in 12/31/2025. So this is a big change, right? So if you're a business owner and, or even somebody that has real estate or has significant other assets, and your estate is above 15 million, it's assessed, everything within your estate is marked to market. They take the market value of everything you own. They look to see whether or not it's over 15 million, okay? If it is, they're going to assess you estate taxes, which is 46%, okay? If it isn't, you're good to go. Now you don't have to pay any estate taxes, okay? So this makes a permanent 15 million exemption on the estate tax side. And the other thing you can really do is it's raising from 6 million, but the other thing you can really do is use that as annual gifting. So a lot of times people don't want to wait until they pass away to give their money away or to give their businesses and what have you to their heirs. And sometimes people want to do it ahead of time. And this exemption, this $15 million, can be used early or it can be used when you pass, either way. So it's really important. I can always get a lot of questions on this. Oh, what do I do? I'm getting ready to retire. I want to give my business to my kids. You can use this one-time exemption and there's also annual exemptions on gifting and so forth, but use this one-time exemption to pass these assets to your kids and let them grow in value as you move forward. So when you pass, there's not going to be an estate tax issue. Um, you know, hmm. Basically, I think the Senate and the Senate and House were in agreement, and they went along together, and they made this $15 million exemption. It's permanent adopted, right? And we don't have any issues with the 2026 sunset anymore, and it helps avoid certain forced sales and other problems like that. Some people, when their estate is above 26 million or 15 million, would have issues where they have to sell their assets in a fire sale, which could cause really real problems. Okay. Enhancement of employer provided child care credit. Okay. Now, if you're an employer or you are an employer that wants to offer child care to your employees, you can deduct up to, you can get a tax credit to up for 40% of the qualified child care expenses, right? And that, and it could be up to $500,000 a year. So if you're somebody who's really trying to help your employees out or get good employees, and the market for really good employees is tough, right? And some people do offer child care services within their firm. Uh, and the great news is there you can get a tax credit for this, like up to 40%. So let's say you spend $100,000 on childcare for your employees so that they can come to work and be comfortable knowing that their kids are nearby or what have you. 40% of that could be a tax credit. So that's a significant savings, right? If you really think about it, not only can you write off those child care credits, but you can also take a you can not only write off those childcare expenses, but you can take a credit for those expenses, which is pretty interesting, right? So, small business, they're looking at a $29 million. This is for businesses under 29 million. Okay. So there's like, you can also use third parties now. You can go into joint facilities now. So really what the government is trying to do in this particular thing is make sure that the employers have the opportunity, especially small business employers, have the opportunity to offer these kind of benefits to their employees. Okay. Um, they went to, oh boy, this is like going forward on me. I better use this. Okay. So this is a in really encouraging employers to be very, very flexible in terms of what they want to do and what they want to offer. Okay. Extension of an enhancement of family and medical leave. So let's say you offered paid family leave. You can get a credit for those paid family leave, right? So it's basically 25% of the wages and 25% of the insurance premiums that you are offering to people that you offer to pay for people on paid family leave. So this is also a credit that you can get back. Of course, the expenses are fully deductible, but you get an additional credit to offer this. Um, Impact in business, right? Raising minimum credit to 30%. And basically, they were looking at 25% in the House version, 30% in the Senate, and the Senate went with 30%. This is extended to 2030. It's indexed after 2026, through 2027. It's the study, but then it's indexed after that. And these are for employees earning under $78,000 a year. Okay. And the requirement is at least 2 weeks of paid annual leave, right? So, exclusion of certain employer payments of student loans. So this is kind of interesting too, and it can actually work with a lot of business owners and their kids. So let's say you can exclude from income employer contributions to employee student loans up to $5,250 a year. Okay. So let's say, you're a business owner, your kids went to college, they have student loan payments that they have to make. You can basically employ them as an employee of your business, right? Pay them some minimal amounts, right? And then also contribute to their student loan payments and write that off your business. This is a great way to make tax-free income happen and also help to take care of your kids, right? So these are payments made after December 31st, 2025. So we're looking at 2026 tax year, and it's good planning, right? So we can plan that. So this was pretty much approved by both the House and the Senate, and it went into a permanent extension, okay, this particular element. So that is always going to be available and something we can really use to plan for, right? In your particular situation. So if you have kids that are going to college, or if you have kids in college that need some help paying for their student loans, you can use this provision. Health reimbursement arrangements. I've not seen a lot of these, but now they're expanding it. And this, I think, really comes down to, let's say you are too small, or you don't even want to get an employer-sponsored health plan, but you want to be able to do something for your employees to have them get health care. You can use, for example, the Covered California, or whatever your particular state is, that particular healthcare um, exchange for your employees to go ahead and get healthcare, and then you can reimburse that coverage. Okay, so this is an interesting opportunity for people that may or may not want to offer these type of arrangements. Right? There's a lot of rules, okay, in terms of how we can do, but there are some flexibility in terms of what we can do. You can contribute to an account on the health reimbursement arrangements, and then those payments come out for the employees. Again, this is basically um, for people that really want to use an alternative to the straight up employer sponsored plans. Okay. And it can, it's interesting because it can there's a lot of different plans that are out there. There are some people that have plans affiliated with their religion. There are some plans that are affiliated with other type of nonprofits that people may want to do instead of using the employer-sponsored plan. So it gives you some flexibility there. This is just the summary in terms of what people can do with that. Participants in a choice arrangement eligible to purchase exchange insurance under cafeteria plan. Basically, what it says, you can go to your exchange and buy this. Okay. And the tax savings could be interesting because, you could get lowers taxable income up to $6,000 a year. For example, if you have a straight up monthly premium, all of this is going to be pre-tax. In a way, a lot of people can do the Section 125 plans for the standard employer purchased healthcare coverage. This basically evens the playing field for the health reimbursement accounts. Employer credit for choice arrangements. This is a 2-year credit for small businesses and businesses with less than 50 employees offering choice HRAs. So, the year one, you can get a credit to do this, $100 per month per employee enrolled, and $50 a month for employee enrolled after that. So the credits aren't huge, but it's something to help you encourage to make these plans happen, right? Extension of special depreciation allowance for certain property. Okay, this is a big one. Where the 100% bonus depreciation is back. We had that in 2017, 2018, 2019. Businesses can immediately deduct 100% of the cost of qualifying assets, machinery, equipment, et cetera, through December 31st, 2030, right? The assets must be acquired and placed in service by January 1st, 2030. And long-term production assets qualifies, plants and trees qualify, in orchards, vineyards, and so forth. There's no phase out. It just ends, and it stays until 2030, but it ends in 2030. Okay. And basically, it's the restoring of this special depreciation allowance, the bonus depreciation, which is really great. Very, very positive, and a thing that I think will help encourage business to go back into investing in their businesses and reinvesting in their businesses. Now, this next one is brand new, and it is 100% immediate depreciation for qualified production property. What's unique about this particular, it's for businesses can deduct 100% of the cost of qualifying property in the year it's placed in service. And it applies to non-residential real property used in manufacturing, production, and refining of tangible personal property. So if you build a production plant, right, If you build something like that is involved in the manufacturing process, you can write the entire plant off at once. Normally, this is 39-year property. So this is really, really unique. Construction start between January 20th, 2025 and January 21st, 2029. So we have a decent window. And placed in service must be operational before January 1st, 2033. In the United States, obviously. And original use must be new to the taxpayer, not previously in production, used in other production activities. For example, what they're saying here is this is a new plant that you're building, right? You can't use it on an existing plant. Excluded properties, office spaces, admin services, lodging, parking, sales, research. This all makes sense. This is for production, right? And qualified production activity, we're going to go down to uh, the bottom line, the bottom paragraph here that basically is require substantial transformation of tangible goods. Okay? Substantial transfer. So if you want to know what production property is a substantial transformation of tangible good. But think about food manufacturing, right? Limited to agriculture production, excludes most services or intellectual property. So we are not, you can't like say, oh, hey, I have this building and I have a bunch of programmers in there producing software, right? Or, I have a bunch of people in there producing services, right? It has to be the manufacturing of tangible personal property. Like, would a winery work? I think a winery would work because you're converting grapes into wine, right? So there are recapture rules you got to be careful of. If property stops being used for qualified activities within 10 years, the IRS recaptures depreciation benefits as ordinary income, okay, via Section 1245. So it is, you know, an interesting situation. So you want to keep that production facility going. The IRS will clarify terms of substantial transformation as it goes forward. So we're going to have to wait for some IRS rules. But nevertheless, if you are planning to open a plant, you're planning to open a facility that, or buy a facility and you can make it into something that produces something and produces a substantial transformation of a tangible piece of property, then you're in good shape, right? And this is basically, the House version was adopted in this that has really a broader scope. And really, really what the government is trying to do here is say, hey, we want more manufacturing. We want to bring more manufacturing back on shore. So if you're like, a Toyota, even like oil and gas companies, or you're like a GM or whatever, or whoever it is, you want to make stuff, right? Really, this is your opportunity to build a plant and write it all off all at once, okay, for tax purposes. So let's say you want to build a $3 billion plant. There's no limitations. You can build a $3 billion plant and take the entire thing as one write-off. This is another interesting one. Modifications to low-income housing credit, okay? This is more funding for the states, increases the annual tax credit allocations to state by 12.5% for 2026 to 2029. Easier financing rules. Projects can qualify for credits if they're 50% funded by tax-exempt bonds. So think about this, right? We're financing low-income housing with bonds, and now we can also get a tax credit for the construction of that low-income housing, right? And also they're really trying to address rural areas, right? Native American lands qualify as hard to develop areas, granting 30% larger credits, right? So there's some substantial credits on this stuff. And if you're into the development business, or if you want to get into the development business, real estate has always been super attractive from the perspective of depreciation, right? You start to think about this and it's like, wow, should I develop low-income housing? Well, probably, hell yeah, because you get the credits, you can do cost seg on the real estate development, and you can also, if you can get financing on low-income housing, that's even better, right? So this is like some really, really interesting stuff. I mean, the government understands that there's a housing shortage. The government understands there's a shortage of affordable housing. This, for all we hear about in the media and social media and all those different accounts. We all hear, oh, this is terrible, whatever, this bill is terrible. I mean, we're really trying to get back production, and we're really trying to get some low-income housing solutions on the table, right? So 15% increase through 2030, right? 30% threshold adopted for the financing, right? Reduce to 40%, reduce to 30. So the 30% threshold is adopted on the financing side. And basically, it is going to be a very effective tool, I think, for certain investments. I mean, you can find those investments. Not only could you get the depreciation and use, like I said, use cost seg, 100% bonus depreciation on property under 20 years, but also get a credit. So it really makes this very attractive investing. Okay. Health savings account, HSAs are changing. Okay. They are going up. Okay. So, as a business owner, you know, and you look at all these different, some of these little things, some of these changes look like they don't add up for much. But together it makes a big difference, right? So HSAs like, $4,300 for individuals, $8,550 for families. It could be a way to set aside money for medical expenses, and HSAs can also be used as a really a long-term funding, additional long-term funding for your retirement as well, right? So there's some great opportunities for that in terms of the expansion of HSAs. They're allowing inflation adjustments, so it'll go up even more as we go forward. Pretty cool. And they also allow some catch up that we can do on this as well, right? On-site employee clinics, okay? If you're an employer that wants to offer an on-site employee clinic, my man, imagine if you're a healthcare employer wanting to offer this, right? You can also get additional support and eligibility from an HSA for our on-site employee clinic. So that's pretty cool. And it allows the HSA contributions for employees with on-site clinics, right? Your gym membership is now qualified to be paid under your HSA, right? So that's gym membership, fitness classes, programs, safety equipment, those type of things you can pay for with your HSA. So it's another way to move some of your money from taxable to pre-tax. And that's something we always want to do in tax planning, is to do that, right? Business tax incentives, depreciation expensing, deduction of domestic research and development expenses. I mean, one of the things that's existed has been the R&D tax credit, which is basically 30% of your increased R&D that you're spending every year. And the challenge with that particular identification of R&D is that it had to be set up and amortized, right? So it had to be capitalized and amortized over 15 years. Well, this is allowing us to write off R&D as you go, right? And a lot of people have more R&D than they ever thought. A lot of ag has R&D as you're developing new methodologies, and there's a lot of deductibility when it comes to research and development. The credits, now, obviously you take the credit and the remaining balance gets to be written off right away. So this is very, very important. And this is 2025 to 2029. Again, the government is looking to increase business in the manufacturing area with having some additional R&D, okay, to get those write-offs. Not only a tax credit, but also being able to write it off, so you can have some additional tax benefits from there. So, great. Increased dollar limits for expensing of certain depreciable business assets. This is what we call a Section 179, okay? So we're going to have 100% bonus depreciation on anything under 20 years. We're also going to have higher limits on Section 179. And, as the bonus depreciation was phasing out, we used 179 more and more to take immediate write-offs. So businesses can immediately write off up to 2.5 million. Previously was a million. Okay. Again, we're looking at businesses reinvesting in their business and taking more write-offs and reducing their taxes. And starting in 2025, these dollar limits adjust annual for inflation. And then, so higher phase-out threshold, the tax rate starts phasing out when total purchases are over 4 million. So, I mean, it was previously 2.5. So we go from 1 to 2.5 million from 2.5 million as the phase out to 4 million. So there's the government's basically saying, please invest in your business, right? Renewal of opportunity zones. This is kind of interesting too. So they're now expanding for those of you who may not be aware, opportunity zone allows you to invest in certain areas. And if you hold on to that investment for 10 years and sell it after 10 years, you do not have to pay capital gains. Okay. So it's the avoidance of capital gains. Now they're expanding this opportunity, right? They are basically updates which areas qualify as low-income communities by adjusting income thresholds to 70% instead of 80% of the area median income. So they're making bigger opportunity zones. They're making rural opportunity zones. So it requires at least 33% of new opportunity zones be rural. They're extending the timeline. So designations for opportunity zones would last until 2033. Previously, it was 2026. Tax breaks for long-term rural investment offers bigger tax reductions, 30% versus 10% for investment held 5 years in rural opportunity zones. Okay. Remember, it used to be 10 years to get 100%, right? And now it's basically after 5 years, you can get 30%, right? Tighter reporting, effective date changed, right? This is the detail that we're going to send you so you know you can take a look at it. R&D. This also modified adjustable taxable income for the purpose of computing R&D and certain business interest that's deductible. They have loosened up on those calculations as well. I'm not going to go into all the detail here. We have it all listed out for you. This again is the temporary expensing from 2025 to 2029 of R&D expenditures, domestic R&D expenditures. I think I've actually already covered that. House of Senate. Small business increased gross receipts threshold for small business manufacturing. Now, to be a qualified small business can be pretty important sometimes. It basically tells you when you're required to use accrual-based accounting. It can also have to deal with Section 1202 when it comes to the avoidance of capital gains on the sale of a small business stock. So what they've done for manufacturing, they've raised the annual growth receipts to 80 million from 25 million. That's a substantial deduction. So if you're in the manufacturing business, you can still be qualified as a small business with $80 million in revenue. Okay. But on manufacturing, 80% of your revenue must come from selling products that the business physically makes or transforms. Excludes foods and beverages that make or sell products on site, bakery, cafes, right? So it excludes those people, right? But if you have a commercial bakery that you make and then you sell it off-site, you would qualify, obviously. So I think it's going to be very, very interesting to continue to do that and to allow people to, remain a qualified small business. Becomes very, very important. Okay, repeal of revision to de minimis rules for third-party network. You remember how they're talking about, hey, if you get a Zelle or you have Zelle or Cash App, or if you have any of the other Venmo, any of the other ways of getting money from other people, everybody's going to have to report 1099s, right? So it's now changed to $20,000 per year annually, right? So there's no automatic tax forms for small users, but that these thresholds users won't get 1099K forms on these payment platforms. So that limit is now 20,000, which helps simplify reporting and creates probably some more opportunities for people to use those cash apps on a personal basis, because a lot of people use that now, Venmo, and Zelle and all those other things to pay other people to do services for them. So there's not that requirement to report it. Okay. Now 1099s. Remember, it used to be $600, right? It's now going to be 2,000. So you don't have to send a 1099 to anybody unless you send them $2,000. Okay. And starting in 2027, it's adjusted for inflation. Okay. So miscellaneous 1099 has gone from 600 to 2,000. Energy environmental provisions, clean energy credits, environmental credits. Man, This is what you can tell you about the clean energy credit. They're pretty much gone. Okay, they're all kind of getting terminated. Clean air vehicle loan. So if you want to get it, you got to get it this year. Just again, December 31st, 2025, they're all terminating. Qualified commercial clean air vehicles credit, December 31st. Alternative vehicle fuel property credit, December 31st. Energy efficient home improvement credit. The solar business is going to have a major impact. There are no more credits after December 31st, 2025. So this year should be a big year for solar if you want to get it done. That's probably the year to do it. After that, it's terminated. That is kind of the same thing, really. These are some phase outs of on clean energy investment credits. So some phase out and restrictions, tax reforms, tax reporting and compliance. Okay. This is pretty much a lot of the through the bill in a lot of areas. Okay. So they're really enforcing strict Social Security number requirements, right? So there's a strict Social Security number requirement for American Opportunity and Lifetime Learning credits. Those are the credits your kids can get to go to college. Has to be Social Security numbers. ITIN holders won't be, they won't be able to get it even if they previously qualified. Okay. So it has to be Social Security numbers, otherwise it won't work. Okay. So that's a big change there. ERCs. Okay. This is an area where we've seen the IRS come after people for auditing their ERCs. They've raised the penalties substantially, $200,000 per violation, $10K for individuals or 75% of their ERC income, whichever is greater. Due diligence failures, $1,000 per violation if promoters don't verify eligibility. So, I mean, they really are trying to go after some of these people that were ERC promoters, right? Defines ERC promoters as firms or individuals charging contingent fees based on credit size or earning more than 20% of the income from ERC services or greater than 500K in ERC related income. Excludes certified professional employer organizations, so PEOs are not included. So it blocks new ERC claims. No more claims for credits unless filed by January 31st, 2024. Extended the ERC IRS audit review for the ERC. So they have up to 6 years to review that. The standard was previously 3 years. So, I mean, this is an area where the government is still trying to see what they can get back from some of these promoters who filed false ERC claims during the COVID epidemic. IRS funding changes. Everybody remembers, I'm sure, under the Biden administration, we did this. So we're going to hire 86,000 or 80,000 new agents to the IRS in this $80 billion bill. So 55 billion of the 80 billion was rescinded. Okay. So that means they took it all back. So that 80 billion was due to modernizing systems, which is desperately needed, improving taxpayer services, enhancing enforcement capabilities, particularly to address tax gap from high income earners and large corporations. So if you remember, Biden's they said, and they've said this before in history, they're going to go after high earners. And by the way, they never do. Because high earners generally have more access to better defense. So what they end up doing is going after everybody they can, and they end up really soaking the low income people on this particular situation whenever they do this. That happened in the 1990s when they did it. And I think it's happened basically 2 times before. The last time they did it in the 70s too. They tried to do the same thing. So 55 billion has been clawed back from the IRS. The remaining 25 billion is now tightly restricted to core taxpayer services, limited modernization efforts, and IT infrastructure updates that support existing operations. Funding earmarked for increased audit and enforcement actions was specifically eliminated and scaled back. Okay. So all of the stuff they're talking about, additional audits and stuff, is gone. Okay. This is good news to the taxpayers that were expecting harassment. And like I said, when they threatened back in, I think it was the 80s, that they were going to audit everybody that made over $200,000, about 70% of the people they audited were people that made less than $200,000. Okay. So audits and high income tax compliance will decline. We think there's going to be delayed modernization. There's going to be customer service, and the Internal Revenue Service is a disaster and has been a disaster since COVID. And for example, if you file a amended return, you should expect that amended return to take at least a year to process. It used to be 12 weeks back in the day, back pre-2016, the 2016 Trump administration and COVID, but no more. Okay. So it's going to be very, very interesting in terms of what happens there. So the summary of the major business benefits: immediate deduction of domestic R&D above and beyond the credit, immediate Section 179 going to 2.5 million with a threshold of 4 million, 2.5 million, and then a phase out after you total expenditures equal 4 million. Low income housing enhancements, right? From 50, and it allows you to get those tax credits, right? On low income housing credits, even if you do 50% or 30% is funded by bonds. Employer credit for choice arrangements, on-site employer clinics, benefits, fitness expenses up to $1,500 individual or $2,500 joint can also be now deducted through HSA. HSA contributions are increased. Increased threshold for small manufacturing businesses, modified interest deduction calculation, which I didn't really cover, but it basically basically it's a technical area that lets you deduct more business interest than before. Bonus depreciation extension. We're looking at $100,000 through 2030. Permanent renewal of opportunity zones and expansion of those opportunity zones. So if you're looking to try to invest in real estate, your opportunity zones are going to be bigger than before. And it's going to give more and more people the opportunity to invest in real estate in opportunity zones to allow you to avoid the capital gains. So clean energy credits are terminated. I think that's the easiest way to remember it. If you want to do something with clean energy credits and you want to do it, you got to do it in 2025. Okay. Repeal of the $600K 1099K $600 1099K threshold, right? It goes to 20,000. Increases in 1099s are now 2,000. We had 2,000. It says 1,000 here, but I believe it's 2,000. The COVID enhancement, right? And then the cutting of IRS funding, I think, is also very, very important. A couple more things I want to talk about aren't specifically business provisions, right? But that really exist, right? And people have talked about, right? Obviously, the standard deduction is increasing as it normally does every year, right? But it's going to be increased to 15,750 for single filers, 23,625 for head of household, and 31,500 for married couples. I mean, it normally goes up every year, but it's going to continue for 2025. It's going to be 15,750 single, 23,625 head of household, 31,000 for married individuals filing joint, right? Personal exemptions, we have the another $6,000 for people over the age of 65 that get an additional exemption above. I mean, if you're single and you're filing 15,750 as a person over 65, you can get another $6,000 standard deduction, right? But it starts to phase out if you start to make above $75,000. QBI, we talked about 23%. I'm sorry. Yeah, I'll take a look at that one. I'll get there. Let me just finish. Which I'll get to your question in a second. Let me just finish up a couple things here. The other thing we wanted to talk about is the SALT cap, which is a big change. Previously you could only deduct $10,000 of state and local taxes. It's now going to be $40,000 through December 31st, 2029. Okay. So I mean, we run into this almost every single tax return. People have more state and local taxes than $10,000. So this will be a help on your personal return to reduce personal taxes, especially if you're a business owner, right? Um, I think those are some of the main ones that I wanted to make sure I also mentioned. Um, ah, Another thing that people are talking about, no tax on tips, right? Really, what it is an additional deduction for cash tips received by individuals on their tax return. So it's kind of like an additional standard deduction if you have tips that will go up to 25,000. Okay. So let's say you make $20,000 in tips. Those are going to be an additional deduction you can deduct from your income. You're still going to be subject to FICA on these, right? And same thing with overtime. The it allows you to have an additional deduction of $12,500 on overtime, 25,000 marrying filing joint. Um, it also phases out. However, if your modified gross income is above 150,000 and 300,000, 150,000 single, 300,000 married filing joint, it it does phase out, right? So those are both not so much a blanket, no tax on tips, no tax on overtime, but additional deductions. I mean, you're not going to have any income tax. You're still going to have FICA on that. Okay, so we have some questions, right? The Q&A section, right? No, see, Butch, $14,600. No, it's going to be 15,750 in 2025. Okay. The BBB changed it to 15,750. Okay. Overtime takes effect in 2025. Okay. The whole bill takes effect in 2025. So we're good there. Again, let me explain that again. Overtime, 12,500 is going to be your exemption or really an additional deduction. Okay. Um, of your income, right? So let's say, tax on tips, right? No tax on tips. Let's say you get, $25,000 of tips, right? And, you would have an additional deduction for your income. You'll still be subject to Social Security on those, but you would have your standard deduction, and let's say you're single, so it's 15,750, right? Then you have another deduction on the tips. So it's essentially free from income tax, not free from FICA, but free from income tax as an additional deduction. And that's in play for 2025. So both of these questions are the same, right? Tax on tips, 25K, tax on overtime, 12,500. So, so like Philomena in the beauty business, absolutely, you get a lot of tips, and those tips are required to be reported on your W-2. The W-2 is not going to look any different, but what you do is you're going to pay taxes kind of as you go along on those tips, depending on your withholding. Although some people may want to adjust their withholding, so that in itself is going to be kind of a nightmare from the perspective of trying to make sure people adjust their withholding properly, because at the end of the year they'll have this $25,000 deduction, right? So it's going to be complicated. This is not so easy to implement, right? Because the pay the payroll organizations really have not come out with how they're going to handle it, whether it's ADP, Paychex, OnPay, or any of these guys. And the way it's worked out is it's just a year-end deduction or an additional like standard deduction for people to get overtime and tips. So it's going to be tricky. And it's a very, very different than how it was sold during the election. Not surprisingly. I mean, they did deliver something, but it's not surprisingly that it's very, very different than what was sold during the production campaign. But the good news is, like in the beauty business, I mean, you clearly have people getting a significant chunk of their income. They may, I don't know, let's say they make $80,000 and, maybe they make another 20,000 in tips. Those tips will essentially become tax free from income tax, not free from FICA, but free from income tax. So, but that's going to be deducted on their tax return at the end of the year. And the payroll companies are going to have to show tips separately on the W-2, right? So there may be some challenges in terms of going back and reporting that. I don't know. You know what I mean? It's kind of an interesting situation. And tips are are really, really in the beauty business, in the restaurant business, in any business where you have hospitality and tips, they're always tricky. And like when I work with business owners that are in that, making sure you get the FICA tip credit for the business owner is really, really important. I don't know if we have any other Q&A, but does that get it? Yes, absolutely. So Butch asked the question, does overtime still pay FICA? Yes. Overtime and tips, you're still going to get to pay FICA. What you do get is overtime essentially becomes a standard deduction of 12,500 and tips become a standard deduction of 25,000. But you still got to pay FICA. All right, guys. Any other questions? Really, really interesting stuff. A lot of big changes. I really I love the a lot of the small changes, the HSA stuff. I love the big change in terms of production facilities. I've already talked to a couple clients that are thinking about opening production facilities to write off the entirety of a building. I think that is probably the thing that almost no one is talking about, and it really is the biggest opportunity, is to create a production facility, right? And to take an entire write-off of that. I mean, if you have a ton of income and you know somebody that you want to get into production business with, I really feel like in terms of economically, there's going to be a rush to create more manufacturing in the United States. Okay. Like I said, I already have a couple of clients that are thinking about doing it, and buying new equipment, getting a new production facility, and everything else like that to expand production and increase their sales, and take 100% write-off on the building. I mean, we have never seen you being able to write off a complete production facility, a 39-year building in the first year. I've never seen it before. So those are some pretty interesting changes. I think what they did to the IRS in terms of backing off the Obama 86,000 revenue agent, not the Obama, sorry, the Biden $86,000 revenue agent plan, and auditing everybody with over $400,000 of income is going to be positive. Quite honestly, what I've seen with the IRS recently in terms of staffing up and hiring people, it has been very, very difficult for them to find the quality people that they could hire. I mean, we've seen a couple of people come to us for audit representation, and the quality of the questions and the quality of the work that they currently do has been challenged by the strains put on nobody loves the IRS, let's put it this way. So nobody wants to give them any money. So it couldn't happen to a nicer group of people. Sometimes there are some very, very good people in the IRS, but there's also some people who are enthralled by their own authority. So anyway, now, oh, I got to close this. Sorry. Don't do webinars every day. So I do have a book on small business profits. If you want to scan that QR code now, you can have that. You get that book load. One more question. Jay has a question. Does depreciation for manufacturing have to be taken in 1 year? It can be spread out over 5 years. The option is to do 1 year, to take it all in the first year. You don't have the option to spread it out over 5 years. However, that's what we're talking about, the manufacturing building, right? However, if you take it in 1 year, you can also have a loss carry forward, right? And that loss carry forward can impact many years after that. Okay. So if you wanted to spread it out over more, there's no provision in the code to do that, but you could just take it all in the first year and do a loss, which is what I would do. I mean, if I have a $3 million building, I would write that thing off in once, have a big loss, and then use the loss carry forward to offset income in future years. Okay. So if you want to scan that QR code, very, very easy. The book's for free. Okay. I have actually a real live physical copy right here. Huh? Oh, it's also available for sale on Amazon. So I'm an Amazon bookseller now, of all things. Seems kind of ridiculous, but I am an Amazon bookseller. Um, Andy, yeah, Andy, the kids can go to 15,750 this year. Okay. Uh, so that would be tax-free income to the kids. Okay. Because their standard deduction is going to be 15,750. So what you want to do is pay them that 15,750. Their standard deduction is 15,750. So there's zero taxes. Okay. 15,750. It's a great loophole that everybody needs to take advantage of. You know, when you think about it, and remember, Andy and everybody else is on the call. Um, when your kids get into college, you can also pay them more than that. Let them pay their own taxes, right? Um, but they can use the lifetime learning credit and the American Opportunity Credit to offset their taxes. So, quite honestly, a bunch of people, and I did it myself when my kids were in college, we paid them to work in the business, and then they use that to pay for their business. They were independent person, right? And then they pay their own. They basically we help them file their taxes, but they got the lifetime learning credit because most people in business, once you make over $100,000, $130,000, that's fade out, right? No, Andy, the 15,750 is per the kid, not per each parent. Oh, are you talking about gifts? If you're talking about gifting, annual gifting of to kids, I'm sorry, Andy. There's two things. Remember, let me talk about that one. So, annual gifting, yeah. Yeah, yeah, yeah. Yeah. So annual gifting, right? So let's look at that annual gifting.
He says yes, gift.
Ah, so the annual gifting limitation for 2025 is 19,000 per recipient. Okay. So if you're looking to drive down your estate, right? Or if you're looking to give money to the kids, you can give each parent can give a child $19,000 each. Okay. So, I mean, that's 38,000 per year per kid, right? So, some people use this in terms of giving them property. It's cash or other property, whatever, stock sometimes. So you can do 19,000 a year per kid in 2025. Okay. That's up from 18,000 in 2024. But each parent can do it. So it's 38,000 is a tax-free transfer from the parent to the child, right? Grants. So if you think about it, let's say the child has two sets of grandparents. Each child can get 19,000 from each parent, 19,000 from each grandparent. So it could be, 38,000 times three, really, which is almost $100,000. Yeah. Yeah, I think I just answered that. Can yes, any other relative can donate or can gift, right? So the rule is 19,000 per person. Okay.
He said thank you.
And that is above, and that is aside from the $15 million limitation. We got another question, yeah. Yeah, you could definitely do that. So the question is, this is from Slavic. Can I put a house in an LLC and gift the LLC to my child? What taxes does that trigger? So yes, you can definitely do that. Um, and we have a couple options when we're gifting, right? You can do the annual gifting we're talking about at $19,000 a year, or you can use that $15 million limitation. Now, Slavic, I believe so. Also, if you have a husband and wife, you have $30 million total exemption, right? So let's say, I mean, your all of your assets, are worth $50 million right now, and you want to give 30 million to your kids right now. You could give 15 million to your kid, your wife could give 15 million to your kid. That it doesn't necessarily, the gifting doesn't trigger any taxes as long as it's under the 15 million. But remember too, the $19,000 per year is a separate limitation, right? The $15 million is a lifetime exclusion, right? You can only use it once. Okay. So you could do that under lifetime exclusion. We can gift the house. It has to be at market value, which is pretty easy to determine these days. Zillow and whatnot, and even a letter from a real estate agent to get the market value of the house. And you can definitely do that. It's the way to make that happen. Do you have any other questions? All right, cool. Really good questions, guys. Very interesting time. I think the BBB, quite honestly, with 100% bonus depreciation, production facilities issues, and other, opportunities for, write-offs, real estate. I mean, man, if you don't think real estate is a great place to invest right now, you're not thinking right. I can only say that, because here's the other thing that's happening. If you got to watch the Wall Street Journal, you got to watch the business news, right? You know that Trump already has two people in the running for chairman of the Fed. Okay. Now, Jerome Powell doesn't come up for renewal of his term until like March, April 2026, right? And Trump already announced he's planning to announce a successor in September, or he's talking about it, right? And he's got two guys vying for it. So it's really, and apparently the word is out through the Wall Street Journal that there's some division among the Fed governors themselves in terms of what they should do, right? In terms of what they should do to interest rates. And I really think Trump is intent on getting interest rates lower. I mean, I think it's really important. I think it's really critical. When you think about this bill and the demand that it could create in terms of for people trying to expand production facilities, right? For people trying to reshore or bring back manufacturing, and for businesses to trying to expand, it means nothing without the ability to get the financing to do it, right? Which I think is really, really critical to the Trump and the Republican agenda. I mean, many people predicted they wouldn't get this bill passed, and they got it through. It's tight. It was tight. There's no question. But if there's some sort of legislative action that can be taken to lower interest rates, I would not bet on that not happening. I don't know if that's the crazy way to say that, but maybe it's a triple negative. But I would bet on some sort of action and continued pressure to lower interest rates. I might, here's the number that I think in my head. They want to lower interest rates by 2 points. Okay. I think if we have mortgage rates in the 4.9s, 4.7s, 4.8s, I think the housing market and real estate construction is going to be awesome. I think there's going to be an incredible demand for money and financing. And remember that the total money supply and financing is not only controlled by the Fed, it is mostly controlled by the Fed and their supply of money and the way they do things. And quite honestly, the Federal Reserve are supposed to be the smartest economists in the world, right? I have questions about that sometimes, because sometimes the way they lower and raise interest rates to try to control the growth and the inflation is like trying to get rid of a cockroach with a 12-gauge shotgun, right? It's sometimes too much pressure on the overall market instead of trying to pinpoint the problem and rebuild it, right? Because our problem on reason houses are too expensive, there's not enough of them. No one disagrees on that there's not enough housing, right? And I look at the big picture in terms of everything the government did in this bill and everything they're trying to do. They're really trying to make the economy grow. Okay. They're trying to bring back manufacturing. They're trying to build low-income housing. They're trying to expand the opportunity zones. Every single thing I talked about focuses on that one goal: is get manufacturing rebuilt, create more good jobs, create more houses, right? And one of the keys is lower interest rates. So I would bet that the political pressure on the Federal Reserve is only going to continue to increase, which is a good thing. So what I think is I think we need, as business owners, to be ready for expansion in 2026. Okay. And I think there's no question that when the 2017 tax bill came in place and it was a major overhaul to the tax system, expansion happened, right? 2017 had passed. 2018 was a very, very good year for the economy. And like people were predicting, I don't know if anybody remembers this, but certainly seasoned veterans like myself remember that people were saying the economy was going to phase out because the expansion or the growth economy had gone on too long. So we're going to get into a downward cycle. And we never did. Had it been not for COVID, okay, COVID was the thing that put us into a down cycle and put us into inflation. And, everything was growing amazingly well until then. COVID hit, the government decided to put out $3.3 trillion, which was basically, at the time, 2 months of the entire GDP in a very short period of time to push out $3.3 trillion of free money to people. And surprisingly enough, a greater supply of money causes inflation, which that is basic economics, macroeconomics. It's supply and demand. The more money you have to chase a limited supply of goods and services, inflation happens, right? So, I think the Fed is behind the curve right now in terms of what they're trying to do. And they're using the excuse of, well, we don't know what's going to happen with the tariffs and everything else like that. No, they don't. But to me, it's like I think the pressure on the Fed to lower the interest rates is going to be immense. And I would, of course, it's not here yet, but I think, you know, as we get into as Trump selects a new Federal Reserve chair in 2026, he's going to select somebody that's going to go with the economic agenda. And the Republicans will still have control of the Senate, and they'll be able to do the confirmation process to be whatever they want to be. So I feel that if Jerome Powell doesn't make it happen, the new person that's going to be in charge will make it happen. Okay. And I think 2026 will be a great year. And I think it's a great time to expand, buy new places, cost segregation, real estate, low-income housing. All these things are very, very exciting, guys. From a strategic perspective and a strategic tax perspective and business perspective, that's what I'm thinking. Okay. People, there's a lot of politics regarding the BBB and, people saying people are going to die and all these other things those are very difficult discussions to have and difficult politics to deal with. But if the economy gets better, as this is intended to do, people are going to all be better off. Anyway, so that's my presentation for today. I'm looking at a good time in 2026, 2027, 2028. And it's a great time to expand and get those write-offs. Thank you. Did we have any other last-minute questions? We're good to go. Thank you very much, everybody. It was great to do this again. If I have more stuff that comes up, I'll schedule another one. Thank you so much.